Developments of in the markets of last week, I think they warrant some more discussion. I want to get into the particular developments around Robinhood and the stock trading and GameStop. I also want to mention Bitcoin and Tesla and how stocks seemingly are behaving differently than before. My conclusion is no, this is the same old, same old. We've had algos for decades now. We've had chart people. We've had all these pseudo analysis tools mixed with artificial intelligence or machine learning that have been driving stocks, like I said, for decades. The difference now is there's more liquidity, it's faster, there's easier tools, such as, for example, options trading for everybody and things like that. But overall, really nothing has changed. So for us in the hedge fund business, I think we just have to be very wary of these things, but I don't think that much has changed in the financial markets. I also disagree with the fact that we have a disintermediation or democratization in the market. In fact, I think it's becoming a lot more centralized than before. This is a Not Even Wrong podcast. It's January 30th, 2021. This is Krim Delco. It's a Saturday. There's no update today. So what happened last week, I think it warrants a little bit more discussion, a little bit more reflection. We had this crazy situation around GameStop where the stock went from 5 to 400 in like 10 days. We have this perception in the market that stocks can just go up for no reason. And we also have this perception in the market that a bunch of mob-like know nothings are driving stocks. We have a perception in the market that something has to be done. And we have particularly so-called professional investors definitely looking at this very scary. In fact, us also, I mean, we consider ourselves professional investors. And my first reaction was also, I was a little bit scared. I was concerned. I asked myself, well, this makes no sense. This is my livelihood, the financial markets, and now it's being taken over by the mob. But I've calmed down ever since I've thought about this a little bit more deeply, because I think here's what's going on. I think first and foremost, this is another algorithm being applied to the financial markets. Algorithmic trading has been around for decades, and of course it has exacerbated in the last couple of years just because artificial intelligence also has increased in popularity. Now, what does that really mean? Artificial intelligence applied to stock trading is the same thing like artificial intelligence applied to anything else, at least in today's version of artificial intelligence. It is analysis of data and then pattern recognition and reinforcing certain parameters that you want and discouraging other parameters. This is really what machine learning is all about. So traditional algorithmic traders, they've looked, for example, at momentum stocks, and when they started getting traction, they would buy more and so on and so forth. With the difference here is that we have an algorithm and we have humans involved within that loop of the algorithm. Let me try to explain what I'm thinking here. I'm thinking that we have a mix of algorithmic trading and Facebook technology, which is being applied to the stock market. This is really what's going on. So what is Facebook technology? Facebook has mastered the art of driving traffic into certain directions, keep attention high, keep interest high, keep engagement high, all these things. They have mastered that over the last 10 years. Now you apply that to the stock market, you have people who pay attention to certain stocks, then keep engaged, for example, screenshots, etc., etc., like screenshots about how much money you made. I mean, things like that. Gamification of the stock market is one example. And I'm sure there's a lot deeper and more intelligent technology than just that to keep people engaged, to keep people playing in the same sandbox if you want. Now you apply artificial intelligence and combine that to the stock market situation. If you could have a hedge fund, let's say somebody like Citadel or some players like that, large players with lots of capital, access to lots of capital, who exploit these trends and then exacerbate them by starting to drive stocks in a certain direction. So I would say it's a very high likelihood that we have a mix of mobster-like social media behavior with large institutional money behind applied to these types of trends that then drive stocks into what we had today. If you look at in particular the stocks that have been in the news the last week, these are all stocks which are heavily shorted. Now let's just hypothetically take I don't want to name names, so let's just keep the names out. Hedge fund X is applying artificial intelligence technology, Facebook type technology to assess trends within social media, to assess momentum gathering, things like that. Then they start moving stocks with their own money, and then they generate robots or maybe even people, real people, that start exacerbating those trends which have been started in social media to then sort of pay attention to, hey, look, the stock is moving, why don't we get involved? On top of that, they have access to the short lending departments of Wall Street. So they go like, at some point, we will just start cutting the shorts. And this is one of the things which is very disloyal and I think very bad in the short market. That is that if you short a stock, you can be called anytime. So whoever lent you the stock to be shorted can call that back to you. And if you do that at the wrong time, you can short squeeze somebody. So it's very possible that this was an orchestrated maneuver by certain hedge funds using social media and AI and the, I would say, malfunctioning of the short market to actually take advantage of situations and squeeze the shorts. So I think what we're dealing here is really a new type of algorithm. It's a new type of momentum trading and algorithm, but in a sense, it's something we've seen many times before. When, for example, chartists came up, so people that looked at charts and started investing following charts, lots of professional investors said, well, this is stupid, this makes no sense, etc., etc. Well, it became part of the market, and it is part of the market, and we always have this momentum here, momentum there, moving average, all that stuff is being thrown around. And there's some people, maybe they can make money with that, others don't, but it doesn't really affect the professional money managers who don't play around with these things. Then there is the algorithmic trading has been around for a while also, which is kind of the next level of chartism, which is you're just using machines that are much faster, much better at recognizing these trends, etc. But in the sense, it's the same thing. You just follow trends, you follow patterns, etc. Now you have this new algorithm, like I explained, an algorithm that is actually using humans also as part of the equation. And you know, I don't know to what extent these humans are important. Actually, you could say, well, why do you need this mob? And in my view, probably this is a fair question. I mean, if you want to drive stocks, um, drive momentum, if you want a short squeeze, you don't need a bunch of Reddit fanatics who do that. So in a sense, it's still an open question. Why does this social media aspect play such a big role? But it is conceivable that given the amount of leverage that these people have access to in platforms like Robinhood, that then maybe they actually can make a difference and also drive stocks to stratospheric heights. What the question from our perspective, from our standpoint, is really, listen, what exactly has changed? So we always had algorithms in the market. I will never forget late Barton Biggs. I asked him in one of the conferences, how are you dealing with the Fed? Is the Fed money printing a problem? This was like something like 2008, 9, maybe 10. And his answer, my biggest problem is not the Fed. My biggest problem are algorithmic traders. Algorithmic traders are very, very dangerous players in the market because they disguise real volumes. This has always been my biggest fear, that they show volumes that where there aren't. And for real money manager like us, so for people that actually put real money into companies and really want to uh, play the game like it used to, like it was designed for financing thing, growth, wealth generation, all these things. So for people like that, it's always dangerous because you can't, let's say, you can't follow volume volume numbers. You can't believe in, well, is there a real buyer, is there a real seller? So what I'm trying to say is we've had to deal with algorithmic traders ever since I've been in this business for now 25, 30 years, if you combine all my experiences. So this is nothing new in that sense. It's new in the sense that it's more powerful, it's faster, it creates extreme, much more volatility, but every new invention in the markets has done that. Chartism has created more volatility. Chartism was considered stupid and, oh, this makes no sense. You can't just follow charts. I mean, come on, investing is a fundamental thing. And of course, the charts said the same thing like all these social media people are saying now, which is, ah, you don't know what you're doing, and you're just the old suits, and we're the new mob, and blah, blah, blah. So all that stuff is the same. When the algo traders actually came up with Renaissance Capital and people like that, again, people said this shouldn't be allowed, this is bad, this is not, this is not. And in the end, it just ended up being just another part of the market that we have to live with. Now, here's what really matters for us. First and foremost, I think it's important to keep our feet on the ground. What is it we're doing? What is our purpose? What are the things we can actually control? What are the degrees of freedom we have? Those are the questions we have to keep asking ourselves. And the answers to those questions are the same like they have been before. We are looking for fundamentally new concepts and engineering practices. We are understanding culture. We are understanding the compound of knowledge, a compound of interest, a compound of market share gains and things like that. For example, for Tesla, the fundamental question for Tesla is not what kind of EV to EBITDA should this company trade. I think this is not the right metric to use. The right metric to use, as far as Tesla is concerned, is this a compound or story or not? And how do you analyze compound stories? Well, you look at the books that are underlying our principle stack, for example, The Beginning of Infinity, the 0 to 1, the Innovator's Dilemma, and the Innovation Stack, and you find relationships between the principles in those books and what's going on in the companies that we're investing in. And if we find enough relationship, we have a good reason to believe that those are compound stories. And if they're compound stories, then the current valuations, the current situation is not as important as the future, because compound, of course, creates a lot more value in the future. So what I'm saying is that the analysis today has to be around things like, how does this company relate to an entity which is going to compound? And if this company relates to such an entity in a positive way, then there is high likelihood that this company will compound. Now, if in the meantime, because of these new algorithms in the market, the stock goes to stratospheric heights, well, then, of course, we have to think about it. We're players in the market. We're measured by mark to market and realized and unrealized gains and things like that. So we can't just be blind towards it. If Tesla goes to $2,000, $3,000 a share, so becomes a $2-3 trillion company, at some point we would have to consider liquidating, because it would be like, yeah, the algo's gone crazy. Right now, that's not the case at all. Tesla has actually many levers of growth, many levers of compound possibilities, many levers of many opportunities. So it's in fact undervalued from our perspective. So we're not concerned. Did this whole new algorithmic trading help Tesla get faster to a higher valuation? Yes. But again, we're not nearly close to any kind of craziness or things like that, like there is with GameStop. Or another way to say, if GameStop is $20 billion, well, then Tesla can be $800 billion. In fact, the equivalent of GameStop for Tesla would be 2 trillion market cap and not 800 billion. So we're very comfortable with that. As far as the actual market dynamics are concerned, we've said that before in other episodes. We believe that the best way to deal with this from a regulatory perspective would be to curb leverage and to deal with the sort of political shenanigans which are going on in the short market. For example, people disrespectfully talking about other people. Things like that, I think, are much more important then some people are saying we should curb this and close that. These are all bad solutions because in the end, free speech and free markets work like that. And there is sometimes uncomfortable behavior. We at Orange Capital Partners have always been of the opinion that the algorithmic trading market should be reformed because, again, one of the biggest problems that the algorithmic trading market always has done is it has disguised real volumes. And volume is an important part of the puzzle. It helps professional investors gauge risk, gauge liquidity risk, and if the volumes are convoluted, you can't do that. So it's a negative thing the algorithmic trading scene has provided, in my view, negative value to the whole market. But that's life. It's the same like maybe if you have populists in democracies, it's a negative contribution to the market of democracy or the market of politics, but it's still part of it, and you can't just close down everything just because there are some negative elements. But again, we are not a regulatory podcast here by any means. So what I'm saying is, from a hedge fund perspective, the purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And the situation right now for us is the following. We are going to continue to do the same work we've done before, which is to find fundamentally new concepts and engineering practices with large impact. We're going to invest money, we're going to manage our leverage, and we're going to also be cognizant of the fact that we have new kinds of players in the market, new algorithms that are partly machine learning, partly actually humans that are being used by those algorithms for whatever their purpose is. And we're going to have to live with that. We're going to, of course, monitor volume metrics. We are not the kind of fund that looks a lot in volumes anyway. But I'm just saying we're going to take the pricing actions with a lot more of a grain of salt. And in the end, we are in the business of generating wealth. And as long as the financial markets function the way they function right now, wealth generation will continue to happen exactly the way it has been always happening, which is in the end, it's the fundamental growth of the company, the compound growth of the company, which will generate the wealth. Thank you.